Hello, everybody. Attorney Kevin Pritchett here for the Law Office of Kevin Pritchett, Keeping It Real podcast. Podcast dedicated to keeping it real and telling you the truth about wealth, legal, and other accumulation strategies to increase your wealth. So today we're going to talk about the IRA tax trap. If you've been listening to the previous podcast episodes, you'll know that I talked about the three tax buckets. And IRAs fit into this middle tax later bucket. The theory behind IRAs. First of all, let me give the legal disclaimer. This podcast is intended for general information purposes. It is not intent to give investment advice, financial advice, or legal advice. If you have needs for financial, investment, or legal advice, seek out a licensed practitioner in those areas for your particular situation. Okay, got that out of the way. Now, as I was saying, today's topic is the IRA tax trap. A lot of people don't realize that the IRA is a serious tax trap. Why? Let me set it up for you. Back in the 70s, when it was clear that businesses were not going to continue to have pensions, that is the guaranteed payment when people retired, the government created this IRA program where essentially you were in charge of your own retirement. Companies can match a certain amount and you can get free money to the extent of that match from the company. The money gets put in an accumulation account. The money grows without tax. And then you take the money out. When you're ready to retire, you do have to pay tax on it then. The promise of the program was that when you take the money out, you'll be in a lower tax bracket. That's almost never the case, my friends. From doing retirement planning for clients for over 25 years, clients are almost never in a lower tax bracket when they're retired. It's when they've accumulated all their wealth. Here's the deal, and here's what you have to understand. And this is what makes it a trap. The government says, watch the picture now, we'll give you a deduction for putting money into that IRA or 401k account. And it will grow within this account, and we won't take any tax as it grows. But at a certain amount of time in the future, 70 and a half, 72, the date keeps changing, you are required to take the money out of the account whether you need it or not. Bam. That's where the trap comes in. The government says when you take that money out, that's when we will take our tax. Now, let me ask you all who are listening here a simple question. Would you rather take the tax, if you were the government, would you rather take the tax on the seed or the crop? In this example, the seed would be, let's say you put in $1,000 into your IRA. And when it accumulates over time, let's say for this example, you have $100,000 in that IRA. If you were the government, which would you rather take tax on? The $1,000 or the $100,000? The answer is obvious. You'd much rather take tax on the $100,000 because it's a bigger amount and you get more tax. It's called taking the tax on the crop rather than the seed. And this is exactly why IRAs are tax traps. If you include all the tax rates, all the possible taxes, the highest possible amount of tax you can pay on an IRA, you could be up to as high as over 70% tax taken out from that IRA. Yeah, I'm not joking. So, what is the alternative? Here's the move. Let me go back to this other graphic here. Staying in this tax-deferred bucket, if you want to use an IRA or 401k, and I'm suggesting you don't have to, I'll get to that in a second. But if you're using an IRA or a 401k, you only want to put as much in here as to maximize the amount of match you're getting from your employer. That is essentially free money. You let that grow, but everything else you want to put in, get over here to this tax never bucket and use a Roth IRA. There are income qualifications for Roth IRAs, and just like regular IRAs, there's limits on the amount you can put in. And there are different types of rules for what kind of instrument you can put in each of these. For example, an IRA, 401k, traditional, are much more restricted on the types of assets you can put in. Self-directed IRAs and self-directed Roths, on the other hand, are much more flexible. I have clients who structured plans where they've done real estate investing through their IRAs and 401 through their self-directed IRAs and self-directed Roths. Again, there are requirements, there are restrictions, so that's why I suggest if you're interested in these strategies, sign up for a one-on-one consultation. We'll review your situation, let you know which strategies are available to you in order to get your wealth accumulation into the tax-favored environment. But by all means, you do not want to rely on IRAs solely for your wealth accumulation because, my friends, it is a ginormous tax trap. Click the link down below, get your consultation so we can go over your situation, let you know what options you have available. If you found this podcast helpful, and I know you did, send it to friends, colleagues who need to hear this same information. Okay, my friends, that's all for today's podcast. It's Kevin Pritchett for the Keeping It Real podcast. Until next time, take care.